Imagine this. You build a company from scratch. Decades of blood, sweat, and late nights. You finally go public, and then some Wall Street suit shows up, buys a chunk of your stock, kicks you out, sells off half the company, fires thousands of employees, and walks away with millions. Ladies and gentlemen, meet the corporate raiders. These guys are the villains, or heroes depending on who you ask, of the business world. They don't build companies, they don't run companies, they invade them, strip them, flip them, and cash out. So what do corporate raiders actually do? How do they make money? And are they evil or just really good at capitalism? Today, we're diving into the hostile world of the corporate takeovers, activist investing, and boardroom warfare. Let's go. Let's break it down. A corporate raider is basically a high-powered investor who targets public companies that look weak. Maybe they're undervalued, maybe they have bad leadership, maybe they just fell asleep at the wheel. The raider starts buying up stock, quietly at first, then boom, they reveal they now own say 5, 10, or even 20% of the company. Why? Because once you own a big enough chunk, you can make demands. You can fire the CEO, break up the company, sell off quote-unquote underperforming divisions, pay out dividends, or merge with another firm entirely. It's aggressive, it's ruthless, and if you play it right, it's insanely profitable. So how did these guys cash in? Two ways: takeover and flip. They buy a controlling stake in a company, force changes, cut costs, sell off assets, and then sell off the whole company or its parts for a profit. 2. Pressure and pump. They don't need a full takeover. Just the threat of one is often enough to shake up the board. The company might buy back shares, raise dividends, or restructure, raising the price of stocks. And guess who profits from that spike? Yeah, the raider. Let's talk strategy. First, accumulate shares quietly. They use shell companies or multiple brokers to stay under the radar. But once they hit a 5% ownership, they have to file with the SEC. But by then, it's already too late. 2. Launch a proxy fight. This is the chess match. Raiders propose new board members, usually their allies, and try to convince other shareholders to vote them in. The third option is going hostile. If the company resists, things get ugly. Hostile takeovers involved making a direct offer to shareholders, bypassing management entirely. It's like kicking down the front door instead of just ringing the bell. And fourth and last is asset stripping. Once in control, raiders often sell off divisions, real estate, or intellectual property. Now for the fun part, the legends. Carl Icahn. Icahn made billions doing this. His most iconic move, the Trans World Airlines. In the 80s, he bought it, loaded it with debt, sold off its valuable assets, and then left it to crash and burn. Thousands lost their jobs, but Carl made a fortune. T. Boone Pickens, oil tycoon turned raider. He targeted bloated oil companies, buy stock, and push for shareholder value, which usually just meant layoffs and mergers. Michael Milken, the junk bond king. He basically invented the idea of financing hostile takeovers with high-yield bonds. He was also indicted for securities fraud, but that's just details. Paul Singer. His firm Elliott Management once seized an entire naval ship from Argentina because they refused to pay bond debt. Literal piracy. So are corporate raiders just blood-sucking leeches, or are they cleaning up bloated and lazy corporations? Critics often say that they don't create value, they just extract it, that jobs are lost and R&D gets cut and companies get gutted. Defenders often say, however, that they discipline bad management, they unlock value for shareholders, and if you're a CEO burning cash and underperforming, maybe you should be scared. It really depends on your perspective. If you're a shareholder, you might love these guys. If you're an employee, not so much. The heyday of corporate raiders was the 1980s. Wall Street white powder, pinstripe suits, and the Gordon Gekko vibes. But after a wave of scandals, Congress cracked down. The poison pill was born. Basically, a legal defense where companies dilute shares to stop hostile takeovers. Today, raiders have rebranded. They're now called quote-unquote activist investors. It sounds nicer, right? But it's just the same tactics with different marketing. They still pressure boards, they still shake up companies, and they still walk away rich. And the line between activist and raider is just blurry at best. Let's bring it into the 21st century. Bill Ackman versus Herbalife. Ackman shorted the stock, claimed the company was a pyramid scheme, and launched a full-blown PR war. He lost hundreds of millions, but the strategy, it's completely classic corporate raider. Icahn versus Apple. Carl Icahn took a big stake and demanded Apple buy back more shares. Apple did cave and stock went up, and Icahn cashed out big. Engine number 1 versus ExxonMobil. This tiny hedge fund won a proxy battle to force Exxon to go greener. Corporate raiders are one of the most controversial forces in finance. Some call them market vigilantes, and others call them greedy wrecking balls. What's undeniable is this: they changed the way corporate America works. If you like this breakdown, hit that like and subscribe button. Thanks for watching, and I'll see you in the next one.